Hey guys, in this video we shall be covering the remaining topics of chapter 2 basic concepts of economics. In the previous video, that is part 1 of basic concept, we have already covered topics like human want, utility, desire, classification, production, consumption, and many more, including inflation. So, we shall be starting with the demand pull and cost pull inflation. What is demand pull inflation? This is basically when there is a demand for a commodity, and because of that demand, its prices increases. That is demand pull inflation. For example, if you want to buy a car and there are many demand for buying car, in that scenario the price of car automatically get increased. This scenario is known as demand pull inflation. On the other hand, for example, if you wanted to buy a car but the cost of raw materials that is required for car like leather, wheels, seats, its structure, it's the raw material gets costlier. In that scenario, the again the prices of the car get inflated, but this time this is not because of demand, this is because of its original raw material. So inflation originating from demand forces is called demand pull inflation. Here the keyword is demand forces is called demand pull inflation, and when the prices of the commodity increases because of the increase in its cost, it is called cost pull inflation. In both the scenario, the end point is the same. That is, ultimately the cost has been increased because of inflation. But in both the cases, the reason is completely different. On the one hand, when it is due to demand, on the other hand, it is because of due to the increase in the cost of raw material. Hope you got this topic very well. So, moving on further, what is value? Now, this is very basic. Value refers to the valuation placed by household on consumption. Generally, there are two types of value. First, it is value in use, and second, it is value in exchange. Now, let's understand with an example. Value in use relates to the consumption value of a commodity. For example, when you consume things like water, it has a very high value of use. On the other hand, when it comes to the value in exchange, it relates to the market value of commodity. For example, in barter system, when we exchange 1 meter of cloth for a kilo of rice, it means the value of one cloth is equal to 2 kgs of rice. In both the scenario, we are ultimately measuring its value, but in the first scenario, we are measuring by satisfying, by consuming, by intaking the commodity and consuming. And in the second scenario, we are ultimately exchanging one goods to another. Now, what is nominal value? No, first of all, we shall mark the keywords. Here, the keyword will be value of commodity refers to the valuation placed by an household. Value in exchange refer to consumption, value of commodity, and value in exchange refers to the market value of a commodity. Now, coming to the next part. Nominal value. Nominal value refers to the value of commodity measure in monetary terms such as rupees. When you buy an apple, a kg of apple, you pay price for it. That is the nominal value of the apple. In real value, coming to the next part, real value. Real value of a commodity refers to the purchasing power in term of a commodity of another commodity. For example, when you exchange 1 meter of cloth for a 5 meter of rice, that means the 1 kg of 1 meter of cloth is equal to the 5 kg of rice. In both the scenario, we are ultimately doing nothing but measuring, but in the first, where in the nominal value, we are taking monetary unit of value. However, in the second, we are giving one goods to another, and then based upon that value of goods, we are measuring the another good. So, what is market? In general, what we understand with market. In physical market, we generally understand like a physical place where commodity are bought and sold, such as Connaught Place, Chandni Chowk, Vegetable Market, Bombay Stock Exchange. But my friends, we are living in an era of development, transport and communication, an expansion of banking network. Now, market is nowhere limited to a physical place of commodity where goods are bought and sold, buyers and sellers are interacting personally. Now, the definition of market has become much wider as compared to the traditional definition of market. Now, in economics, market means a system set up where buyer and seller of the commodity are able to interact and communicate with each other and strike a deal about the prices, the quantity to be bought and sold. So, we may conclude that market is a mechanism where buyer and seller are bought together. However, in today's era, it is not definitely needed to be physically at the same place at the same time. There are, when we compare economic sense of market with the traditional market definition, there are two distinguishing factors among them. The first, there now in economic market, there need not be located in a particular place, and the buyer and seller need not have any personal relation among each other. As we have completed with the concept of market, we may proceed with the types of market. There are two types of market. The first market are the goods market, where the goods and services are bought and sold, and the second market are the factor market that includes labor, capital, etc. So, what is money? What is money and what is the use of money? Money is basically a medium which is used for exchange of goods and services. But in the past 100, 200 years ago, when money was not invented, people used barter system, where barter system is the system of exchange where goods and services were exchanged directly for another goods and services. For example, if a farmer have rice and he wants wheat, he exchanges 1 kg of rice with another 1 kg of wheat. This was the barter system. But barter system was highly inefficient, and the nature of exchange was clumsy. It involves wastage of human efforts. Even it also restricted the scope of specialization and diversion of labor. It was considered as obstacles for the economy. To overcome this deficiency, money was invented. Money act as a system for exchange of various types of economic transaction. Anything which is generally accepted as a means of exchange at the same time act as a measure and store of value is denoted as money. Let's break the definition of money to understand more clearly. Anything that is generally accepted, for example, we can't use a normal note or any other substance for exchange because that is not generally accepted. There is only money that is generally accepted in the current economic transaction. So, anything that is generally accepted as the means of exchange and at the same time it acts as a measure and store of value. Now, how your parents save money? Save their savings. Usually they store in the form of money, either in bank or at home, but they use money to store their value. Here comes the complete definition. Anything that is generally accepted as the means of exchange and at the same time it acts as a measure and store of value. Money usually consists of currency and deposit money. Currency again include notes and coins. To add on, we all know that currency is backed by the power of RBI because anything that is has the government validation is termed as money. Any paper other than money is basically a piece of paper because it don't have the legal backing up. And the deposit money are the money that is held with bank in the form of saving, FD or other deposit. So we have completed this part. Coming further, income. What you understand income in general life? Income is basically what you earn in exchange of goods and services. Coming to the economic definition, income is defined as the flow of goods or services accruing to an individual or all people in economy at the same time. For example, if you provide service, you receive monetary value for the service. This is known as your income. And the value of final goods, of services, of the economy produced by domestically people owned factor during a period is known as national income. For example, when your father earned for you, that is your income. But when you consider entire India as a family and the income of the entire India, that is the national income. The characteristic to understand national income, there are few considerations to keep in mind. National income is always expressed in monetary terms. It always reflects the value of final goods or services. Because when you consider the intermediary goods and when it again converts into final goods, it may lead to duplicate counting of the same income. To avoid this duplication of income, we usually and always take the value of final goods and services. Thirdly, national income is flow of final goods and services. This is the same point only. What is per capita income? Till now we have understand what is national income. So, when you divide the total population of your country with the national income, this gives the per capita income of the country. That is the average income of the normal resident of a country in a particular year. It is denoted in value and in monetary terms. Well, coming to the next part, we all know what is saving. It is your portion of your income which you usually save. So, saving refers to that part of income which is not spent on consumption. As a student, when your father or your mother gives you 50 rupees, but you spend only 40 rupees and 10 rupees you keep in your pocket for your future use, that 10 rupees is your saving. Similarly, when a part of income is not spent on consumption, that forms the part of your savings. There are three types of saving. One, savings which is done by the whole household, that is the personal saving. Where the individual saves, that is the individual savings. When a business is achieved by not distributing all the profits made to the shareholder, that is business saving. And when the government saving is done by the central government, state government and local authority, that is the government saving. So, investment is the act of using productive resources for the production of capital goods. In basic and simple language, investment is using a portion of your income and investing it in a particular area which will help you to generate goods and services in future. The major component of investment goods are producer fixed investment, where a business or an entrepreneur invest in plant, equipment, tools, machinery which will help them in future to generate goods and services. And the next is investment in residential and non-residential structure, where investment is done in real estate like house property and non-residential like land or other commercial building. The next is investment in stock, that is like trading in share market, or all firms keep a stock of raw material, semi-finished goods and finished goods. What is wealth? Wealth refers to the stock of all assets that forms part of your source of income. Basically, wealth is the positive indicator of your income. Anything to be regarded as wealth must have the following characteristic. Firstly, if it is wealth, it must possess some utility. And since we have already studied what is utility, utility is basically a sense of satisfaction which one's get by consuming it. So, if something is giving a sense of satisfaction, that is your wealth. Subject to all other characteristics are satisfied. Coming to the next features, wealth are scarce. For example, anything which is unlimited, it can never be considered as your wealth. And so, the wealth must be scarce in supply. Also, it must be transferable. For example, you may transfer its ownership from one person to another. And most importantly, to be considered as wealth, it must have a value, because anything which doesn't have value can never be considered as your wealth. So, different ways of holding wealth by individual may be grouped into three main categories. First is holding wealth in hand in form of money. Second, keeping your wealth in the form of financial assets like bond, FD, deposit with company. And the third, real assets in the form of houses, farms, and family businesses. Now we are almost to the end of this chapter. Welfare. Welfare is taken to a sense of satisfaction and happiness, a sense of well being among the people. So, when you are fully satisfied, you are happy, you are at the feel of satisfaction, that is, you are in the state of your welfare. Many factors influences this sense of well-being, such as your consumption of goods, like what kind of goods you consume, and services, environment, family relation, degree of freedom, law, and order situation. Further, wealth can be categorized into two parts: economic wealth and non economic wealth. Economic wealth refers to that part of social wealth that can be directly or indirectly measured in terms of money. So, the part of wealth or your welfare which can be denoted in money, that is the economic wealth welfare. When your welfare is affected by non-monetary welfare, that is the non-monetary non-economic welfare. For example, when the welfare is influenced by environment, social relationship, laws and order, degree of freedom, that is your non-economic welfare indicators. Now, coming to the next topic, business cycle. So, what is business cycle? Let's understand with this graph. Every product, when it is in the stage of introduction, it have its own cycle. So, when we draw that cycle, it has a curve, and the curve has the four parts: expansion, recession, dispersion, and recovery. Whenever a goods are produced or introduced in the market, it usually, as and on the demand increases, this curve gets higher and higher on economic activity. Once it reaches its saturation point, that is also known as peak, it tends to decrease. Its demand tends to decrease. That can be because of many factors like competition, new competition, new entrant. This leads to the decrease in demand. And when the demand is at the bottom, that is, it is in the stage of depression, it again take a pushback for the recovery. So the curve increase, peak, decrease, and again increase. This is known as the business cycle, and basically it has the four parts: expansion, recession, depression, and recovery. Now, coming to the last part of this chapter, e- aggregate supply and aggregate demand. What is aggregate demand? When the demand of all total amount of goods which the buyer wants in economy desire to purchase. This comprises of demand for consumption, demand for investment, and the demand for government. So, the keywords are to aggregate demand may be defined as the total amount of goods which all the buyer of the final goods in the economy desire to purchase, and the total supply refers to the total amount of output with all the firms of producer are willing to produce. We must not forget that there is always scarcity of demand and a scarcity of supply because uh, nothing in this world is unlimited. So, aggregate demand, it is not necessary that aggregate demand is always equal to aggregate supply because demand is influenced by our desire, and we all know desire is unlimited, but the supply is always limited. So, here we complete our second chapter, and from tomorrow, we shall be starting the chapter 3 of this series, that is, basic problem of an economy. So, if you find this series useful, please do like the video and do subscribe the channel for the upcoming videos. Thank you so much.